Thank you. So now we're moving on to our panel. So just before we do that, a little bit about my background. So I previously spent 10 years in a bank funding team, looking at all the different ways that bank franchises can fund their balance sheets. At the time, we're on the forefront of innovation with the development of various debt instruments and at the wholesale and retail level. So when I started helping startups, I found very quickly that funding one's venture can be one of the hardest things and the most time-consuming and stressful things, parts of being a founder. And most founders that I've spoken to love the idea of debt. It's non-dilutive, and they don't have to give away their equity. So they'd love to get it on board and sort of help with working capital shortfalls or asset purchases. But they're pretty worried about the consequences of doing so, if they can't service the debt. Today, we're going to talk about startup-friendly debt solutions and demystify some of the real genuine options that are designed to help rather than hinder startups. So it's an absolute pleasure here to have our three panelists, experts in their field, joining us to talk about startup-friendly debt financing. I'm going to let them introduce themselves. So first, we have Nick Gainsley from One Ventures. Nick?
Hi, everyone. Hello, can you hear me?
Yep, can hear you loud and clear. Welcome.
Perfect. Thank you. Hi, everyone. I'm Nick Gainsley, so I'm a principal at One Ventures, heading up our venture credit fund. Just quickly, One Ventures is a firm. We're a multi-strategy tech investor. We've got about $500 million under management across equity and debt, and all technology. And within technology, we cover healthcare actually as well. The debt fund itself is an $80 million fund, doing checks between 1 and 10 million. I'll tell you more later.
Cool. Next, we have Jody Imam from Attractive Ventures. Jody?
Hello. Hi, everyone. My name's Jody. Do we want to introduce ourselves as well as our company at this point?
We'll do the company in a second. Let's start with yourself. Yeah.
Okay. All right. Cool. So Jody Imam, I've done lots of different things. My first tech startup was called Occasional Butler, a marketplace for getting small jobs done around the home and office, which was acquired by Airtasker. You mentioned earlier, Jay, it was an exciting week for Airtasker. I co-founded Depot 8 Co-working, one of the first co-working spaces in Melbourne. I set up the Innovation Bay Angel Networking Group in Melbourne as well. I'm a mentor at StartMate and most recently led the team at SBE Australia, which is an accelerator for women-led business, and now COO at Attractive Ventures.
Terrific. And thank you, Jody. And Ted Dow from Paddington Street Finance.
All right, can you guys see me?
Yep.
You can. Sorry, I can't see myself. So if you're staring at my ceiling,
that's okay.
We can see you.
Okay. Yeah. Thanks, Jay. My name's Ted Dow. I work at Paddington Street Finance. Despite my accent, I've been in Sydney for over 20 years, working in private debt, leveraged finance, and more lately, renewable energy. So I've worked at places such as AMP, Westpac, Babcock and Brown. During the GFC, I completed a management buyout of the division I ran at Babcock and Brown. If some of you have been around for a while, you know the history of that institution. It no longer exists today. But that was a private debt business, brought that business out of Babcock and Brown, ran it for a couple of years, grew it, and later sold it to a large US asset manager. More recently, I helped to set up and served as the chief investment officer of the Clean Energy Finance Corporation, which is a $10 billion essentially a green sovereign wealth fund with a mandate to invest on a commercial basis in clean energy and low carbon projects. I retired from that position a couple of years ago, just planning to live the simpler life of a board director, but that didn't quite happen. Nevertheless, I sit on a number of different boards in addition to Paddington Street, China-focused renewable energy fund, an online sports tipping business, a green hydrogen avionics business, and smart electricity grids. So a lot of what I do today either involves unusual debt structures, hence the subject of this panel, or renewable energy. Thanks, Jay.
Thanks, Ted. So yeah, perhaps it's good to sort of run through as well. Maybe Nick, if you want to kick things off, just to talk a little bit about venture debt and sort of how you guys look at things.
Yeah, definitely. And I skipped over kind of my own background, so I'll give you just 20 seconds on that as well, rather than the firm. So
Sure.
I've been in Australia kind of 2 years. So I moved across from the UK to head up the venture credit fund at One Ventures. Background before that was at the largest player doing venture debt growth debt in Europe, a firm called Keiretsu Capital. They've got about 5 billion Aussie under management just on this initiative, and for about $500 million per year into really the whole of Europe and Israel. Before that, I was doing corporate finance and debt advisory back at KPMG and through the GFC as well. In terms of venture debt, I mean, ultimately what we're doing is we're a complementary form of capital to equity. Typically, we're coming in alongside equity rounds, or could come in between rounds, but effectively we act like a venture fund in our approach. So we're not a credit fund. We don't think like banks at all. We kind of take a much more holistic view on a business, but really come in where businesses have venture capital equity already in the business, have already reached a stage where we feel they can support debt. So it's kind of 3 million plus revenue and reasonably high growth. So normally growing 50, 100% top line, but we'll go as low as kind of 30.
I think you were
I was muted. Yeah, Jody, tell us about Tractor. Thanks, Nick.
Cool, no worries. So we provide a flexible revenue-based financing alternative. And so put simply, we offer revenue-based financing, which is a loan that you pay back with your top line revenue each month. So with that too, we wrap around an advisory component, and we are targeting companies that are doing about 50K in revenue every month. Some a little bit lower, and most actually around 100K a month. And sort of really looking for not rocket growth, but sort of gradual, steady, more Tractor-like growth. So yeah, the biggest thing is it's very effective on cash flow. We give an upfront honeymoon period, and it's only at 5% of your revenue each month that you're paying back. And obviously it's non-dilutive, and the advice component really helps founders unlock that next level of growth.
Great, thanks Jody. And Ted?
Yeah, so at Paddington Street Finance, we're focused on 2 target markets which aren't well served by traditional financiers. So the first one is basically our flagship product, what we built the firm around initially, and that's R&D tax incentive finance. Very specific, very niche product. And then what we refer to as mid-market corporate loans, which is probably a bit of a broader term. But R&D tax incentive finance essentially brings forward potential receipts under the federal government's R&D tax incentive program. So those of you that are familiar with it, you know that it's not a grant program, although it's often referred to as such. It's a reimbursement program. You need to spend money on R&D, you file your taxes, and you reclaim those monies, which means in the interim, you've funded that R&D with equity. So we're bridging that gap and essentially displacing equity in the capital structure by providing debt against the prospective receipt of that R&D tax incentive. So it's pretty specific, pretty niche. We're straight fixed income investor. We don't take equity warrants through that product. And our corporate loan product, the mid-market corporate loan product, initially was envisaged as a graduation project. At some point, companies are no longer eligible for the refundable R&D tax offset. You get a tax credit, but you don't get a tax rebate. And that happens when turnover exceeds $20 million. So we have a corporate loan product for the relationships that we form, and we hope so that we can continue to serve our client base. And generally that's targeted at companies that are either cash flow positive or have a line of sight to being cash flow positive. And in terms of sizing metrics, on the corporate loan, we're looking for companies where we believe we're going to see EBITDA of $1 to $5 million. For the R&D product to make sense, you really need a cash burn of probably in the order of minimum $1.5 million a year. And just sizing that, whatever your cash burn is, provided that it translates into R&D expenditure, we can fund about 1/3 of it. So most of our clients are probably more in the order of cash burn of about $3 million a year. So we're providing them funds every year of about $1 million a year. But none of this client base isn't one that's static. You're either you're either going up or you're going down, or you're running out of cash and going out of business. So it's constantly evolving. So that's what we do.
Thanks, Ted. Can I ask my first question to the guys who have sort of got a bit of a venture background, and Nick and Jody, in the minds of founders, what should they be looking out for when deciding on the funding source? Is there certain things that they need to sort of be worried about, or what signals that they need to do before decide?
Sure, happy to go first asking that. I mean, for me, I think companies should ultimately consider like what the use case is for those funds. Like, what do they need the debt for? What are they funding? How do they see the plans going forward is really important. So obviously, a particular sort of financing is, some is better for certain circumstances and some for other, and therefore, and how you see that evolving over time. So, our products, we can start quite small and go quite large, so you can continue taking funding for us as you mature. I suppose there's also understanding the dynamic between wider banking products or wider debt products and how they fit in. If your business needs a lot of funding going forward and you're on that VC path, then our product may be suitable. If you have different funding needs or haven't got an investor, other products could be more suitable.
Cool. Jody?
Yeah, I think the biggest thing to consider, especially early on, is what the path is for the company over time. So, I see a lot of startups, founders that have sold too much equity at too low a valuation, and then don't have too much to work with going forward. And I think that's where some of these debt options are such a great alternative to save on that dilution while you're still fairly young and the valuation is low. It's good to look at debt options in that case, so that if you can see that with this money that you can, as Nick said, when you deploy, exactly what you're using the money for. If you can get to the next inflection point, then your valuation goes up, and then you're able to negotiate a much better term sheet with investors upstream.
Terrific. So I'm going to ask about suitability, and I think each of you have sort of talked a little bit about the timing or the revenue amounts that are really suitable, really optimal for them to approach you. But what are the when is the best time? Is there any other information you can give around best time to look at each of your offerings? And then to maybe sort of wrap a little bit of context around that is to sort of give an example of a company that you've invested in that is perhaps an example of that. So. Well, I've got you, Jody. Maybe you kick off.
Yeah, sure. I mean, a lot of the companies, and Tractor Ventures launched in December, so we're a startup ourselves and figuring this out as we go along. We've got 5 companies in our portfolio. We're adding another 4 in the next couple of weeks, and pretty much all of those companies haven't taken any investment yet. A couple have had some early family and friends money invested in, and what they're really looking to do is just continue to save on their dilution for as long as they can, and so keep bootstrapping the company as long as they can. And for them, the biggest thing is that they want to grow the company at the pace they want to grow it. Whereas when they're talking to VC, they're often seeing that the conversations are around, this thing has to go from 1 to 100 pretty quickly, and that means hiring all these people and doing all these things that they're not necessarily comfortable with. So the companies that we're working with are, they're doing about $1 million a year in revenue. They've got small teams between 5 and 10 people. They know they've got this proven product market fit, so they're excited about what their next growth stages look like, because it's just a matter of just unlocking some of the areas that for growth that they've already identified, that if they just have the capital, they can unlock quicker.
Great. Ted?
It's many and varied, but I maybe if I think about it more in terms of user cases. So where we seem to find we're quite relevant are companies that are not startups. They're beyond the seed capital stage, but they probably haven't raised their first big round of VC. Maybe they're still with friends and family and high net worth. So that's where we seem to step in, because our class of capital, we can put it in place in 2 weeks. Often we're dealing with people who are planning to raise capital within the term of our loan. But as we know, a quick capital raise might take 3 months. If you've done it in 3 months, you've done very well. So often we're bridging that. And as Jody says, sometimes it's just about getting more runs on the board and a better valuation. A lot of the companies we're dealing with, not all of them, I'd say about half have revenues. Interestingly enough, there's kind of 2 entry points where we seem to be relevant. And it's either just before that big venture capital raise, or sometimes it's after, because sometimes you have companies that they're in a VC portfolio, they haven't grown as quickly as the venture capitalist might like, and they're becoming quite capital intensive. So at that point, you have a venture capitalist who's saying, actually, I don't want any more equity dilution. I need to get some more growth into this company in a through a non-dilutive source of capital. So then they kind of come back to us a little bit. So that's kind of where we see that we've got most applicability. We're either bridging a capital raising, or we're helping a company get more runs on the board, or perhaps sometimes you've got a company that just doesn't plan on raising VC. And in that case, we really like those companies because we seem to be a permanent part of what they're doing.
Great. And Nick?
Yeah, for us, I mean, the product is very complementary to equity, and normally it's coming in, the most common case is coming in alongside institutional equity, and normally from a VC. So we say from the earliest entry point, really we do a deal as kind of Series A onwards. So it's very common, we'll come in along a round, you'll raise a Series A or you'll raise a Series B. You'll take some equity from a third party and debt from us, and it'll be a complete solution. Or shortly thereafter, where you've completed a funding round and the debt then gives you further capacity and firepower to scale the business before that next raise. So that's kind of the most common timing, but it ultimately actually can also sit in between rounds to help fund further organic growth or even acquisitions. So we recently completed a deal. We gave funding to a company called Indebted, which is a digital debt collector, they call it that. I've done it Series A, a year beginning of last year. Actually saw opportunity to make an acquisition, and we part funded the acquisition alongside a con note. So there's a bit of each. Another deal we recently did a company called CoAssemble, which is a SaaS business in the kind of learning development space. And that was where the investor EVP did a Series A probably a year before, and it was pure debt going between. And the use of the debt helped extend that runway, allow them to accelerate growth before then doing the next funding round. So usually the equity funding piece is a key around timing, and then the stage and making sure the business is the right scale to support the product.
Great, thanks, Nick. Now we're going to talk about risk. So just really sort of unpack the main risks associated with each of your structures. What's particularly around what happens if things go wrong, and how's your structure best placed to mitigate those risks. Nick, we'll start with you.
Sure. I mean, ultimately, I'd say the risk of the product is like any debt product. I mean, you've got to make payments back. So it's contractual payments out to the lender. Our product has amortizing payments, amortizing capital. So after we can do short periods of interest only, but then you'll start paying back interest and capital. So the biggest risk is we will increase your monthly burn, but we'll give you access to capital. So it's being able to manage that monthly burn and make those payments. In terms of what happens if things go wrong, I mean, the reason why we're comfortable to lend to cash burning businesses and come in early is, one, we understand technology, but two, we come at things from more of a holistic, flexible mindset. And we are a VC fund. We don't get scared if people miss their numbers. I mean, the vast majority of companies miss their numbers. We don't get scared if there's bumps in the road, because all businesses going through early stage have bumps in the road. So when things go wrong, we want to work with the company, with the investors, to find a solution and keep the business going on. We're definitely not in the business of ever trying to just demand our money back, because from looking at a lot of these businesses, if anyone demands their money back when they can't pay, the business goes bankrupt, everyone loses their money.
And Jody?
Yeah, I mean, we see things similarly to Nick. Our whole reason for being is very founder focused, and so our debt is unsecured. So there's actually not really any risk to the founder. For us, we do a fairly comprehensive due diligence, and we're looking at really satisfying ourselves that this is a strong enough company that will be able to make the repayments. But I guess the way we mitigate our risk too is in that advisory component that we have. So we're working in and with the teams on a daily basis. And so for us, we're really hoping that the founders that we're working with will say to us, "Oh, this is looking a bit, I'm getting worried about this," and we can help steer away from any major disasters.
How much time are you spending on advisory versus new business?
At the moment, there's a lot of new business, but the way we work with our portfolio companies we're setting up is a fortnightly call. So that's just a locked meeting every 2 weeks. So we touch base, and then everything else is all on Slack, and it's just they can ping us anytime or give us a call anytime, and then that ebbs and flows. We've had a few situations pop up where the founders have really needed a lot of support, and then they're off for a couple of weeks and they're not really hitting us up. So it's a flow.
Great, thanks. The makeup of a startup's balance sheet is generally pretty vanilla. There's probably a bit of equity, might be in the form of a SAFE. They might have an ESOP program with some options, which for venture capital is great. As they often shy away from complexity. A VC will go, if you've got some weird instruments there to fund your venture, VC might say thanks, but no thanks. So what I'd like to understand is how your solution fits alongside certain types of investors. And Ted, I might get you to answer the last question first about risk, and then we can talk about how your debt solution fits alongside the makeup of the balance sheet, and whether that would deter your venture investors.
Okay. So two-part question.
Yeah, sorry about that, mate.
Multi-part, really.
That's okay. Well, that's all right. I guess to some extent they're linked a bit, but we're a little bit different in that the key risks for us are generally, we would say, are threefold. And the first one is that the company is actually going to be eligible for the R&D tax incentive. That's a specialist piece of legislation. You have to understand it. You have to understand the eligibility. And above all, we need to know that we've got good tax advice that sits around our financing structures. And often a company will be very much wedded to their advisors or their accountants. And occasionally, we find they're getting tax advice from, Joe's Accounting in Liverpool. And no disrespect to Joe in Liverpool, but he's not an R&D tax specialist. So we make sure they're getting that right first and foremost. The second biggest risk for us is we have a shorter time frame horizon. We don't need to see the upsides. We don't really need to think too much about their growth. And we often sit down with founders and say, stop showing us all the upsides. Stop showing us your sales plan. We need a downside case that shows that you get through your tax filing season, because that's all we need to believe. And if you get through your tax filing season, you have enough cash flow and liquidity to do that, then we reset at that point in time and we look at your plans for the future year. So we're looking at the cash that we're providing them, their existing cash resources, and we're taking a view on whether they're going to make it through their tax filing season. The last element is, it's as simple as, are these people that we think once we write them a check, are they going to abscond to South America and lie on a sunny beach? And, are they people of integrity that we want to work with, that we're comfortable working with? Because in these businesses, stresses can run high. And when stresses can run high, that's when you really see who people are. And you want to make sure that they're people that you want to be in bed with when the sun isn't shining and, everything isn't going their way. So that's, I think we're kind of black belts in those things. We're black belts in understanding how you increase your probability for getting the R&D tax incentive, because we've seen, I guess by now, something like 70 different companies that we've invested in. We've had some that have had stoushes with the tax office that we've helped them work through, given our knowledge base. So we've got a great database of what companies need to look like and what approach they need to take to get the R&D tax incentive. So that's how we de-risk things for us. Short attention span. So the next question is how does debt sit on a balance sheet, and are people comfortable with it, right?
Yeah, so have you heard of instances where your particular debt has deterred other investors coming to the party, whether they be equity or debt?
So I think the answer is no. But what's interesting is that there still seems to be a perception out there that the presence of debt could have that sort of impact. I don't know where it comes from, but I certainly, my experience is certainly in private equity prior to this. You're not going to see a private equity player make an investment without the presence of debt. It's an integral part of what they do. The other thing that I do notice is that many of the companies that we deal with already have different forms of debt. They might have a convertible note, for example, or a pref share, or something of that nature. If you look at certain venture capital investment structures, they're essentially pref shares. They have a liquidation preference, just like debt does. They get paid before the rest of equity does. That, in effect, is a debt instrument. So when we're dealing with the parties that we feel we want to deal with, who are generally more sophisticated parties, they're comfortable with it because debt is just a part of everyone's personal and professional capital structure. People have credit cards and home loan mortgages. So the issue that we perhaps deal with a little bit more for companies in this sector is they just don't know that debt is even an option. So I often feel like someone's come to us because they want to order a steak dinner, and we're going, yeah, have you thought about the salmon? Because that's an option for you, and maybe you want to think that through a little bit. And it's a little bit like the Spinal Tap conversation where you keep going, no, these go to 11, these go to 11, 10. So I would say it's horses for courses, but when you're dealing with companies that are a little bit more mature, have been around the block, it's not an issue because it's just a part of every suitable capital structure. Great.
And so quick answers from Jody and Nick, and then we're going to have sort of finish. I think Victor's got a question he wants to ask as well. So Jody.
So balance sheet, just how we see it, or
well, no. Would your debt solution deter other types of investors?
Yeah, actually, it's a great question, and it came up on a Clubhouse just last week, and with LinkTree, and they were saying not at all. And actually, I think it's the founder proposition and investment proposition in our instance is strengthened because of the whole. If we've invested in this company and then we've supported them and got them to the next sort of point in growth, then it's actually seen as a favourable thing. So it's not from what we've been talking to, and a lot of the VCs, we work with and are recommending companies to us all the time, and see it as a great complement.
Great. Yeah, we've definitely got a few we can throw your way.
Yeah, great.
Nick?
Yeah, I think it depends on the nature of the investors coming in. I mean, ultimately, look, we take security on the business. We like to be sole lender, but we're happy to carve out if there's specific forms of working capital finance. Maybe it's an R&D loan like Theodore's has. I mean, we can be flexible around that. In terms of new investors coming in, I mean, they need to be comfortable with debt in the business. If they're not comfortable, they can repay the debt. That's one way of solving it. So we have no problem if they want to do that. But as the product becomes more and more understood, and therefore they understand the risks around it, then it's more and more accepted. So it shouldn't put people off. I've got lots of experience of companies raising multiple financing rounds after taking on a product like ours, going public with a product like ours. It can remain in. There's always going to be people who don't understand it. And I suppose key comes back to what you were saying, what question you had earlier in terms of who's the debt coming from, and therefore do they trust that those people aren't going to abuse their position and they're going to be people they want to work with.
Exactly. Victor, I think you had a question you wanted to ask.
Yeah, actually, one of my questions have been mostly answered by you guys in terms of what founders typically have the most concern with. But I think I heard the answer to that from Jody and Ted. So my other question is really around when you go to market and you come across companies you want to fund, what's your typical competition? Is it from hearing from Ted, it really comes into competition because it's so specific and niche, right? But I mean, is that true? And how does, let's say, more traditional mainstream capital sources like banks and other lenders come into this or do they? Do you encounter them much at all? Maybe Nick, if you want to have a crack at that.
Yeah, I wasn't sure if I was specifically Ted that question in terms of what you're asking, but I mean, in terms of mainstream,
that from all the panelists.
Yeah, in terms of mainstream lenders, I don't see the competition would come from similar providers to what we're doing. Like, I don't see mainstream banks or mainstream later stage providers doing what we do, because it's a very, very different risk profile. I mean, banks look at a business and say, you know, how much cash flow are you generating? How much cover do you have over your, you know, cash flow each month? Am I covered enough? Is enough risk? And what hard assets can I put my hands around? And often they want direct guarantees and things at early stage. We're very different to that. So we have a very different risk appetite. You're paying more for that flexibility, but ultimately we're pretty different.
Jody?
Yeah, I mean, I think when I'm talking to founders, they're really weighing up traditional debt, and that's something that, you know, has been a real education piece, because, you know, they're often asking me what's the interest rate and what's the term of the loan, and that's not how this revenue-based financing works. There is no set term. You know, you can pay back in all sorts of different ways, so there's not really a comparable interest rate for us. If they are able to get some cheap bank debt, then we say do it by all means, like if that's what you're looking at. But actually the founders that have been choosing us over alternatives have been those that really see that cash flow benefit, where they can deploy this capital with our help and bring in that revenue that, you know, with traditional lending, it's, you're paying it back pretty aggressively straight away, and that's restrictive to growth. So, you know, it's definitely they're choosing between traditional debt and looking at equity as well, and seeing what's the difference and what's the best thing to do right now.
Thanks, Jody. Ted?
So we often tell people is, and I guess everyone on the panel could say the same thing, so you might steal my tagline if you like it, but please don't. We often say that we know we're not solving debt problems. We're solving equity problems with a debt solution. So we're not competing with debt, generally speaking. There are other players that are out there that are a little bit like us or are substitutes for us. But when we see a big four bank, and occasionally Macquarie used to have an R&D lending platform, but they shut it down. Other big four lenders have tried to come into the space, but they're just not responsive enough. So whenever we see, say, big four bank debt, it's fully personal guaranteed. And that's both in the R&D product space, and it's also in the corporate loan space. The sort of loans that we're providing, people come to us and they accommodate a higher cost of capital because we are a source for equity, and they don't have to give personal guarantees, and they don't have to have a piece of real estate that backs their loan. So when we're feeling like there's competition, it never seems to come from one quarter. It might come from Nick, it might come from Jody. It's just different options that, or it could even come from a capital raising that just happens faster than somebody expected. And in that vein, you know, we're aware of other people out there, but we just run our own race, because a lot of what we do is really just focused on, are you someone that we want to deal with, and are we someone that you want to deal with? Because if we are, then we'll be very supportive, and hopefully we'll have a long-term relationship.
Thank you very much. Indeed.
Terrific.
Startup friendly, right?
Always.
Absolutely, absolutely. Guys, that's about all we have time for the panel. I'd really like to thank all three of you for joining us and imparting your wisdom upon us. I'm sure everyone's learned a fair bit about debt within the startup realm. Thank you very much, guys.